This is John Persinos, Editorial Director of Investing Daily, with a video presentation for Friday, July 16. To view our full range of publications, visit investingdaily.com. Also visit our subsidiary website, streetauthority.com. Well, trying to process the news lately is downright exhausting. Rising inflation, the COVID Delta variant, extreme weather events, droughts in the U.S. West, partisan rancor in American politics, geopolitical turmoil, persistent cyberattacks, ransomware, you name it. The daily barrage of sensational headlines prompts many investors to wonder, what's the next shoe to drop? Let's step back from the market's daily ups and downs to examine the big picture. Investors face a good news, bad news scenario. A major positive for the stock market is the continuing strength of corporate earnings. So far, second quarter 2021 earnings are beating expectations. The average consensus estimate is for Q2 corporate profits to post a year-over-year gain of nearly 64%. Take a look at the following chart. The operating results of the big banks this week have generally beaten expectations. The financial services sector is a barometer for the wider economy, and so far, the numbers are bullish. Indeed, the pandemic-battered economy is on the mend. New applications for unemployment benefits fell last week to a new pandemic-era low. Investors have been spooked lately by the spiking consumer price index, sure, but the recovery is on track, as exemplified by stellar Q2 operating results from the big banks. The bad news? Well, valuations are at nosebleed levels. The cyclically adjusted price-to-earnings ratio, a so-called CAPE ratio, currently stands at 38.24, which surpasses the levels reached right before the 1929 and 1987 crashes. Speaking of bubbles, the red-hot housing market is reminiscent of the lead-up to the financial crisis of 2007-2009. Take a look at the following chart. Standard & Poor's reported in June that its S&P CoreLogic Case-Shiller National Home Price Index posted a nearly 14.6% annual gain in April, up from 13.3% in March. That represented the 11th consecutive month of rising prices. S&P CoreLogic's Case-Shiller's 20-city composite notched a 14.9% annual gain, up from 13.4% in March, surpassing the consensus expectation of a 14.7% annual gain. Housing prices in all 20 cities rose. Soaring home prices boost the so-called wealth effect for Americans, yes, but the run-up also invites speculation, reminiscent of the subprime mortgage crisis that triggered the financial crash 14 years ago. Case in point, private pension funds right now are snapping up homes across the country, outbidding home buyers and then jacking up prices. Remember collateralized debt obligations, aka CDOs? They were the villains of the financial crisis of 2007-2009 and helped trigger the global meltdown. They're coming back into vogue, believe it or not. The reemergence of highly risky CDOs doesn't seem to bother anyone in government, but it should. It bothers me. I'm bullish over the long term, but sell-offs probably lay ahead. There's one proactive move you can make now to protect your portfolio. Calibrate your portfolio allocations. The following allocations, as recommended by our flagship publication, Personal Finance, generally make sense now. Take a look. The crashes of 1929, 1981, 1987, and the more recent tumbles of 2007-2009 are all examples of situations when investing in only growth stocks with the highest potential return was not the wisest course of action. We saw that last year with the pandemic-induced crash. Credible research studies have found that asset allocation explains nearly 100% of the level of investor returns. Under current conditions, rotate into defensive stocks. Also emphasize value. Your wealth preservation strategy should include the right asset allocation tailored to your financial goals. Keep plenty of cash on hand for the bargains that are sure to arise after another market sell-off. As a hedge, consider adding gold to your portfolio. Precious metals, such as gold, are classic safe havens, especially if inflation heats up, as most analysts expect. Commodities and agriculture-linked investments also help protect investors from the ravages of inflation. I expect modest inflation, but not runaway inflation, but you still need gold in your portfolio. Forget exotic assets like crypto or meme stocks. Our investment team has pinpointed 5 safe, high-yielding stocks that you need to buy now. You can think of these stocks as bulletproof buys. These bulletproof stocks have withstood every dip and crash over the last 20 years. One of these companies hasn't missed a single dividend since Richard Nixon was in office. Remember him? And this company is still a buy. Fact is, There's seemingly no end to Wall Street's dangerous investing fads. When the fear of missing out rears its head, you should get nervous. It means the sky is getting filled with shoes about to drop. For details about our 5 ultra-tough stocks to buy now, consult the article that accompanies this video on the Investing Daily website. Well, that does it for now. Send your questions or comments to mailbag@investingdaily.com. I'd love to hear from you. Bye for now, and thanks for watching.